again.
Hi there, everybody.
Start again. Easy.
So my name is Stan Luker. I'm a partner with Transaction Services Group at Moss Adams. We're a regional firm, but we're quite large, about 3,000 employees, 180 partners based here on the West Coast. Today's topic, and that's why we've assembled this panel, is on what is it that you need to do to change in your day-to-day operations to have your company ready for a financing in anticipation of a due diligence. Our panel today consists of Rory Driscoll, who's a partner at Scale Ventures. Rory's on the board of several very prominent companies, one of them being Box and DocuSign lately, and taken several companies public and also had big strategic exits. Scott Davidson, who's the CFO of Hortonworks. Hortonworks is the fastest software company to 100 million in history. They did it in 5 years. And Scott came in and took him public in less than 6 months. And previous to that, Scott was the CFO of Quest Software, who did multiple acquisitions and sold to Dell eventually. And then we have John Meeks, who's a managing director at TA Associates. He's been with TA Associates for over 30 years.
20. I'm not
20
that
years,
old.
sorry.
I'm 42, damn you. Exactly, damn
I was trying to claim that we have over 100 years of experience here in M&A, so
we're down to
bumping
90.
that up. We're down to 90. But John is a co-lead of the technology practice at TA Associates and had formerly ran their European operations, so lots of experience as well. And then my partner, Bill Sturges, who's kind of the head of tax for M&A in technology for Moss Adams. And Bill's advised multiple clients in the last 12 months on their exits and acquisitions as well. So with that in mind, just kind of to frame what the environment we're in, and over the last 3 years, there's been over 5,500 transactions that have been disclosed, valued at over $800 billion, I think. Yeah, $809 billion. So if you are on the board of a company or you're part of the management team of a company, it's fairly likely that within the next 3 years, you're going to see some type of due diligence on your company. So what is it that you need to do in your day-to-day to be constantly ready versus getting ready at last minute? So first question that we have for the panel, and the format will allow you to ask questions after each of the topics that we discuss once the panelists have a chance to answer them. So you can address your questions directly to them. And we'll probably take 4 or 5 questions, time permitting. So the first topic is, what are the 3 most common issues that you encounter during due diligence, and what do companies need to do to mitigate those in advance of due diligence, and what processes they need to put in place in order to maintain that prior to due diligence and not react to it? Rory, maybe start with you.
Oh, I thought it was at the end. Okay. Oh,
You are.
yeah. Wrong end, clearly. Okay. Yeah, I'll pick on just 2 things.
Sure.
One tactical and one strategic. I'll do the tactical one first. I was thinking about this. When you think about it doing an M&A, the best proxy for what really matters is actually when you get to negotiation on the reps and warranties, what will they limit to the escrow? In other words, it's just money and a small amount of money. And what will the buyer say, I want to recourse beyond the escrow, typically to the full amount? In other words, I really care about this. And because you really, as a venture guy getting the money, you really argue about those things, right? And invariably it's fraud, ownership. In other words, can you rep the cap table, patent, and tax? And yeah, maybe there's something else once in a while, but those are the big 4 where you just end up in screaming arguments with the acquirer, and then the company's trying to sell, and then as an investor, that you're saying, oh my God, I could get this money, I might have to give it back. But all of those are the big 4 things that typically acquirers care about and will go to the mat for. So those are the things you need to prepare for, and I'll kind of lead. I'm sure some of the others can talk about how you do it with probably more precision than I can as a CFO, rather than just an opining board member who says you should do this and then leaves. Right? And then the second thing is, I'll just say, I think the biggest issue you encounter in due diligence is none of the above. The biggest issue you encounter in due diligence is the buyer didn't really want to do the deal, right? And that's what kills you. Because the dirty little secret is this: if the big guy or gal wants to do the deal, then everyone else is a process administrator and they just push it through. If there's not a consensus at the top to do the deal, anything can derail it. So I would argue the first thing that you need to do, the thing that you see in due diligence that's the most troubling, is when in the prior to due diligence phase, in the LOI stage, the buyer for some reason wasn't really there. And that, how you impact, what do you do about that? Especially if you have a competitive process, you really have to factor in more than you realize probability of close. You know, because you look at some deals and you go, they're never going to buy this damn company. The CFO hates it, right? And then you look at some others and say they so should buy this deal, it'll happen. So I think that's something people just don't factor in enough.
Yeah, I wouldn't argue with any of those things, right? From a buyer's perspective and a CFO who sometimes lands with a hot steaming mess sort of after the deal, after whoever the investor is or the corporate treasurer that pays for it, the team that actually then has to run it afterwards. Cap table is always a big thing, right? You got to rep to the cap table clearly, but one of the things that you know, we spend a lot of time looking at is we typically buy software companies.
Yeah.
And so when you buy software companies, a lot of which are not in the United States, and this may seem somewhat basic, but you look at the source code and you do all the types of things you want to do in terms of how clean is the code and so on and so forth. But some of the basic things like how well is the code annotated, so you don't end up with a bunch of spaghetti code that, for those that didn't want to do the deal, that don't come along transitionally after the deal is completed, that you have to piece back together. So as a matter of fact, Stan and I have done a couple of deals where the company that, or the team that wrote it were Russian. The code wasn't annotated in English. We don't have Russian speakers, and that's something that comes up in diligence, which is the first time I'd ever seen that.
Okay.
But you know, Spanish easy, you know, some other languages obviously easy. Russian speakers in Southern California are few and far between.
Especially not of them in Washington though, so we'll be okay.
Yeah. So you know, yeah,
Took a second there.
Touche. So the quality of the code is always a big thing in terms of owning it afterwards. From the CFO's perspective, the other thing that we spend a lot of time on, if the company's kind of moved to the point where they do have revenue, then it's what do the financials look like, right? In many cases, you end up with, and we've lived this, companies that have quick-in financials. Well, we're on Oracle or NetSuite or whatever, and if you're trying to do basic things like map the cost of R&D or map the cost of the sales expense or commissions or whatever, and you got to drop this stuff into Quicken and do a bunch of surgery on it versus looking at financials that are actually audited and have value to them, that's a huge difference and something that we look for. It's really important if you're a serial acquirer like we were when I was at Quest, because what you could end up with is, while one individual transaction may not trigger reporting requirements that you have to take those financials and actually show them in your 10Ks or Qs, but if you do a bunch of deals together that in the aggregate trigger one of these requirements, and like deal 2 or deal 3 didn't have audited financials, go try to do that after the fact. Because the SEC doesn't really care. It doesn't matter that you can't reconstruct that. So the quality of the financials, even on smaller companies, is something that comes up. And it's worthwhile spending the money if you're going to go down this path, hopefully willingly, to actually sell your company or to take investment, that the financials are something that can be deciphered and audited, or at least compiled in such a way that a acquirer can take a read on.
So I think when you look at the market too, we're big buyers and sellers. So I think last year we would have distributed $3.5 billion, invested $2 billion. So we're on both sides of the market. And I think these guys described a little bit of the public company scenario. Public company scenario is brutal on a small to medium company. You know, the data room, the number of requirements,
Yep.
the obligations in the purchase and sale agreement have just a much, much higher standard and threshold, because you can infect the whole thing. Whereas in a fund that's a private equity fund, or in a sponsor-backed acquirer, so we invested 16 companies last year, but our portfolio companies bought another 60. Yeah. And so that's happening is these guys are looking for recurring revenues, how much cost they can take out, how predictable the business model is, the reduction of any volatility. And what's really important, which was standard operating procedure in Europe, was people would prepare a VDD, and that's a vendor due diligence report. You can do it on the market, but people don't really look at those. But the financial due diligence reports that can be done by, you know, the BDOs, PwCs, Moss Adams, I think they're super valuable, because, you know, everyone wants to make sure those financials are spot on and right. Otherwise, the deal breaks.
And
but
we
financial investors are so much faster. So much faster.
And here in the U.S., we refer to that as a sell-side quality of earnings. But yeah, in Europe, it's definitely much more prevalent, and it's been traditional for over 20 years.
And you want to do the add backs to the EBITDA. You want to get all this stuff ready and right. And it's an accounting-led function more than it's an investment banking-led function.
Okay. Bill, tax perspective?
Yeah, so I'll take one of Rory's points, maybe go a little deeper on the tax side. I think in terms of expectations, if it's venture-owned, I guess you look at it from two perspectives. One, what does the seller expect their after-tax dollars to be? Which is less of an issue if it's institutionally owned and it's a C Corp. They know they're probably going to sell a C Corp, and it's pretty straightforward. If you have an entrepreneur-owned company, sometimes there can be a misunderstanding. They might think they're getting capital gains, but they're really getting ordinary income. That comes a lot with software and license sales. But again, I think probably the exception where you have the entrepreneur selling. But on the exposure side, that's where I think you run into obstacles. And so particularly in technology, a lot of times companies are running at losses. And the accounting department isn't necessarily the high priority. I've been told a number of times we're not an accounting, we're a sales-driven organization. We're not an accounting-driven organization, and as they should be. But having said that, a lot of times people have in their mind, well, if we're losing money, why would we have any tax issues? And there are a lot of non-income tax issues that can, at best, slow down a deal, and at worst, potentially torpedo a deal. So those would be things like sales taxes. Most states now are taxing sales tax where you have a SaaS model. I shouldn't say most states. I'd say about a third of the states are taxing sales tax. And so that's one where you want to address that because that's a pass-through tax to your customer. And so why would you want to carry the burden of that tax as a seller? And so that one's obvious. And a lot of it is just about understanding what the issue is before the LOI is signed. So you can put a fence around it and frame it as best as possible to a buyer. Another one that comes up probably less frequently in sales tax, but does come up, is withholding. It's a non-income tax, but anytime you have a royalty fee between jurisdictions, there could be withholding, irregardless of whether or not a company is making money or not. I worked on a deal last year where the IP was in Israel and the U.S. was licensing it, and they had absolutely no idea that there was withholding, and they were caught flat-footed. And it really dramatically slowed down the deal. And I completely agree with Rory. If the buyer wants to get the deal done, it's going to get done irregardless. But it can
deal fatigue, yeah.
It can slow down a deal, and it also can affect purchase price. At least in theory, it can affect purchase price. But again, that is mostly driven by the motivation, I think, of the buyer and the quality of the company.
So at this time, anybody in the audience with questions or points of discussion relating to this topic? One. All right, we can move on to the next topic. So in the last 2 years, the dynamics of valuation for tech companies, at least in the public markets, have seemed to dramatically shifted where it's no longer growth is valued as the number one thing. Now, a lot of people are talking about break even or even profitability for companies. That's also now drifting into, and I think Scott has felt the brunt of that. That's why he's smiling.
Yeah.
But that's also drifting into the private markets, and high growth companies that are expecting a certain valuation are not getting it because they're not close to. They don't have a line of sight on profitability. So with that in mind, what is it from the buyer or seller's perspective, that's appropriate for a valuation multiple? Is it revenue? Is it EBITDA? A combination of the two? How do you guys approach it now with the dynamics that are evolving?
I think most companies are buying EBITDA right now. I mean, you talk to Microsoft and all these things. They want really big companies. They don't want to mess. They want tuck-in things that you don't care about, or they want really, really big companies at the Oracle and all these things. So people care about earnings, and then the public acquirers care about the net income and all the stuff beneath the line. But the platform companies and the financial investors care about where they can get EBITDA to that's in a predictable way, defended by recurring revenue. And these models like ad tech and clean tech and gaming and all of these things that were less recurring have dramatically fallen out of favor.
I mean, I think if you look at the large proportion of companies that get acquired based on revenue size happens before they hit 50 million in revenue. Much heavier weighted if you look in the last couple of years.
Yep.
In tech companies, based on that, even though the cost to start up and run a tech company, whether SaaS or on-prem, is a lot lower than it was a few years ago. So the expectation is companies can get to break even or burn less than they could a few years ago. In December 14, when we went public, not one investor on the roadshow asked us when we were going to stop burning cash. Now I don't go to one investor where they ask when that happens. So that window's come in, much shorter. And I think when you look at the data and you assume that most companies are bought before they get to 50 million in revenue, a lot of companies in the tech space don't get profitable before 50 million. What you find is the reality is investors want both. And the reason investors want both is they say, we want the fastest growth that you can give us and the most profitability. And the reason is because they've never actually run anything. They don't know that those things are somewhat mutually exclusive. So if you look at the data today, there's a very high correlation, from an R-squared perspective of a multiple that's tied to the net of both the revenue growth rate and the EBITDA margin. And in SaaS world, there's this old sort of historical notion called the rule of 40, which basically says if you're growing at 40% on the top line, you could be at break even. If you're growing at 20%, then you should have 20% margins. And if you're growing at 50%, then you can burn 10%. That was sort of in vogue years ago. Everybody forgot about it for a period of like 14 to 15, and now that's what we hear about again. And so what you find is if you plot all the public software companies against that metric, those that have the highest rule of 40 trade at the biggest multiple. And there's no doubt about it, it's pretty consistent. The private companies, you don't see all the valuations, but I can tell you, because I was on the board of a private company, which is one of TA companies as well, they follow form. So just because you're a private company and you're not marked as those of us in the public market are day after day, don't fool yourself, because you have no liquidity. And so a buyer that comes in is trading at a discount when he thinks about buying that company off of a public valuation, because the quality of the financials is generally not as good. Cap table is probably sketchy. Who knows about the code? And you don't have a lot of exits in a market where you can't raise capital. So those multiples are typically a turn down. But get to profitability or some measure of growth and profitability sooner rather than later, and that will be much more helpful on valuation.
Rory?
Yeah.
Thoughts?
I mean, invariably in this discussion, everything everyone says is true. The question is it useful, right? Because, in the end, let's start with basic. Everything is valued on a multiple of free cash flow in the end, right? And, if you wait long enough in a tech company, as very few do, you end up valued on that basis. And, Microsoft's waited amongst the longest, and it's valued at 7 or 8 times EBITDA, because you can value it that way, right? Everything before that is a looser approximation because there's less data, right? Because you simply can't. So you say this intellectually. I've got to give an example. I've got a $50 million revenue company, roughly operating at break even. I'm going to value that on a multiple of cash flow. No, I'm not, because it has no cash flow. So when you're saying, well, I'm going to value it at 5 times revenue, intuitively, what you're saying, and you never spell it out like this because people don't, is I believe that there's some intrinsic free cash flow that this company will develop at scale, and by the time it gets to that scale and burns a little more capital, discounted back, it's roughly worth 5 times today. Mm-hmm. So just think of them as rules of thumb that are attempting to summarize succinctly what really is an expectation of future cash flows. The odd thing about the rule of thumbs is a lot of time they work, right? I'm a geek, and sometimes I've taken the trouble to do long DCFs. And the funny thing when you do them all is you arrive back at the conclusion that the rules of thumb are roughly correct. And that makes sense, because if people are using them for 20 years in investing, the people who get it wrong leave the industry. So the people who survive develop the rules of thumb, and they're the survivors. Mm-hmm. So a lot of these stuff works. So the reality is below 50 million, you're going to value the damn thing on a revenue multiple basis.
Probably 3, not 5.
What?
Probably 3, not 5.
Yeah, well, well, actually, that gets to the second point. Yeah, some of yours, well, you're a buyer, see, you're just positioning. I
And
know
a
what you're-
seller.
Right,
And a seller.
if this shit sells at 3 times, we're screwed. Okay, so
Yeah,
you know, so that's the first comment, which is it is all think of everything as an approximation for a very distant endpoint, and the other question then is it fluctuates around, and that's because the more and more you use approximations, the more fluctuations you get. You're estimating something that's far away in the future, and if you're even slightly long, it's wrong.
Yeah,
Right.
and I agree with that. I think the other thing to keep in mind here is if you're a smaller company and you've got a revenue multiple, whether it's 3 or 5, and it depends on when you look, right? Because that
Or
discounting
13 in some
mechanism
cases.
changes over time. But the other thing to think about is not all revenue is created equally,
Totally.
right?
Yep.
So in our business, 80% of our business is subscription revenue, 20% of it's professional services. The professional services probably trades at 1 times revenue, right? And the subscription maybe 3, 4, 5, whatever the day is. And so when you think about the types of revenue streams that you're building in your company, because they all have different cost profiles to support them, they all have different visibility profiles of what sits in deferred revenue, not investors or acquirers will pay different multiples for different streams of revenue within the same company, irrespective of when we think they're going to get to cash flow, which is a great point.
Well, with that in mind, though, if you've got a company that has, is burning cash above the 40 rule, and you're coming in there and advising them well before the acquisition or any kind of exit could happen, what are some of the more operational, fundamental fixes that you see that are low-hanging fruit for them to do in order to position that?
Well, I mean, it depends. It depends. Well, first of all, I actually, where do you start? Like, the rule of 40, right? Watch this. There could be 2 companies. One growing at 80%, losing 40%. That fits the rule of 40. One growing at 40%, growing 0. Both of them are on the rule of 40. Both of them are okay. Yeah. But the reality is, it's harder to sell the 80. It's harder to sell the 80 growth, 40 net loss, because what John said is right. Buyers don't want to buy mess shit, right? But on the other hand, that might be a better investment. So, you don't take, like, if your objective is to sell the company, you take that 80% growth, 40% loss company, and you converge it on a 40% growth break-even company.
Right.
But if your objective is to run the business, you might say, I'm willing to live with that expensive, but nonetheless value-creating optimal situation. So it depends on what you're trying to do. Right.
John?
It also depends how big the market is too, right?
Market
I mean,
size.
if you got an opportunity to grow at 80% and you've got investors that are willing to fund it, and you don't need an exit that's being forced upon you, and you got time to continue to grow into that, there's very few opportunities that, again, I know we're talking about theoretically 80%, but if you're in really deep, rich markets and you can grow fast, and it's not just burning 40%, it's logically all investors, and I do the same thing internally with our expense profile, is it's not just let's get to burn 40%, because if I give 40% to my sales and marketing department, they'll start to say, well, we want 50, and we want 60, and they could spend it. There's no problem with that. The question is, how do you spend it for every dollar I spend to get 2 or 3 in return, and when that comes, right? So it depends on the size of the market.
You got to be locked down on your return on sales
Exactly.
and marketing expense to justify that. And
Right.
so you have to be able to show that you're getting relatively quick paybacks. And I think the second thing is exactly right. If you're number 1 or number 2 position, you get a premium because people think it'll be a long-term higher margin business and you can have it shot at a 5x versus a 2x revenue multiple.
I'm being told that we need to wrap up, although we started late. I mean, we still have a couple questions. I mean, I'd like to open it up if there's any other questions. Go ahead.
Yeah, just a quick question. So talking about software and the rule of 40 is interesting. I wonder if you've had any experience or what are the rules of thumb for consumer-facing hardware?
I think those are really, really volatile right now. You look at the Fitbits and the GoPros and all of this. There's been anything hardware related has been very scary to investors and acquirers.
Yeah, no. As yet, I passed on the Fitbit round at 100 pre, and I left 10 times the money on the table. But yeah, they're deeply volatile. It's not as obvious what the rule of thumb is. I mean, I just don't have one. I will say, I think some people have created a lot of value in hardware on an astonishingly little amount of paid-in capital, and I just go, that's got to be good.
Go ahead, sir.
So positioning for fundraising, okay, you guys looking at a company space, you like it, everything looks great. What will turn you off advice to give the entrepreneur?
Be really honest. Be really honest. If you think someone's not giving you the straight news, you know, there's a million things to do out there, and people hit a hard right for the exit.
I'd like to challenge the comment about hardware. Our business is in commercializing hardware, and I like to say that Amazon, you can say their hardware strategy has made them quite an impressive innovation company. As long as you get the strategy in place.
It's got a platform.
Yeah.
It's the world's biggest company.
I'd see them on the hardware side. I'd see them as more of a reseller. I mean, it's, you know.
Well, I'm saying
No.
the Alexa platform.
Yeah, but it's just a different beast altogether. It's like comparing the U.S. government to Lithuania. You know, we're talking about advice for small companies. It's just different.
I mean, remember, I thought the question was on rules of thumb. I'm not saying they can't be good investments, but unlike a SaaS company, there's no, I mean, it's all about the feel, right? It's all about the product, it's product market fit. You know, if the product, the dirty little secret about a consumer hardware product at doing $20 million, if the product is right and the market is huge, the multiple doesn't matter. If the product is wrong, the multiple doesn't matter. So I don't have rules of thumb. Like in a SaaS company, like if you pay above 5, you might be in trouble. If you pay above 10, you're toast. In a hardware company, it either explodes or you're wrong. So I'm not saying, to be very clear, they're not bad, they're bad investments at all. What I'm saying is you use a different matrix for decision, and the financial factors are much less important. I mean, I think the number one thing I missed when I passed on Fitbit was this. Despite the low usage, people have aspirations to be fit. So they spend more money on the Fitbits than they, like it's the new gym membership. I won't actually run, I'll just buy a Fitbit to think I can run, and it makes me feel good. And for $100, what the hell? And you know.
And then when you're on stage, it looks like you're fit.
That's exactly right. Well, sometimes it shows if you're not, but
I think they're more capital intensive though in general. As a general statement, the hardware companies.
No, you're competing with China.
well, the thing is,
Right.
You can get knocked off in a half a second. So there's very short product cycles. You got to go through a Christmas window that's about this wide, and you got to stock a bunch of shelves and things like that. So the inventory, it's like someone told me about the video game industry years ago. It's like the worst of the movie business combined with the worst of the toy business. It's just, they're just really, really hard to make work, and the success stories are really few.
Hard to predict.
Yeah, the enterprise hardware space is pretty ugly too, right?
hard.
You know, I mean, we just saw Nimble yesterday, what was 3 times revenue for a company doing 400 million break even.
Several hundred million of capital invested, 400 or 500 million. These are hard.
So the return was really tough, and part of that one was they're going against, they're getting eaten away by Amazon, who's got their own infrastructure. They got EMC and guys like NetApp on the other side. So that's the problem on the enterprise hardware side. Right? Different issue, but same result.
Okay. Any more questions? Oh, one more. Last one.
The panel on structuring earnouts from the
Revenue only. You'll never get them otherwise.
I was going to say, if you're on the side where you're the company, try to avoid them. You know, the earnouts, at least the ones I've been involved with, are used sort of the wrong way, and they're used as a bridge for valuation, right? So the expectation of the company is we think we're worth 5 times. The investor says we're worth 3 times, and I say let's split the difference and we'll give it to you in an earnout, knowing all well that once you come into the company, you don't have the capacity to drive everything that you had on your own to get to the earnout. So what it ends up with is a bunch of false expectations. And the problem with it is the buyer doesn't ever get to the earnout, which justifies the multiple that they paid. The seller doesn't ever actually earn it, so they feel they left too much money on the table. And the more intricacy the earnout is beyond just revenue or the things that you can kind of control, at least somewhat, is harder. Even the revenue piece is difficult because if you take a product, drop it into the sales org, but you don't control the sales org and they can divert and sell 10 different things, you end up on the wrong side of it. And so you're constantly sort of chasing your tail. So I would say use them very judiciously, and if you can avoid them, sort of all the better. You know, tie it to maybe, you know, employment after the fact and other sort of softer things if you can, but tying it to a hard metric like that's hard.
It's interesting because we have a strategy for the earnout. We founded a company called Sturges, and we sold to PG, and the earnout was our secret weapon. They actually had to pay us outright because the earnout was doubling each year. And so it's interesting when you have the right strategy.
Yeah, I think, well, I've not seen a model like that. I think in a situation, and I don't know all the details of this, but if you're sort of a core high-performing team and you go into a P&G that needs expertise that they don't have anywhere, it may be helpful to get there, but which sounds like it may be the case, but I've not seen them work, I guess.
Statistically, the odds are against you on the arc.
You want to get good tax advice too if you're going to enter into an earnout.
Yeah.
Ordinary income.
Yeah, the tax man cometh.
Deemed in.
Yeah, it's deemed income. Yeah, that's the other piece, right? So if you're thinking about
Not only are you not going to get the earnout, but you're going to get screwed on the tax man now too. But,
You
but
can,
thanks for coming.
believe it or not, you can. So.
Okay.
And by the way, I don't plan on paying it anyway when I sign it. Right?
You can still get screwed even if it's not if it's not paid out. You can get stuck with a capital loss because you're having to defer basis on your upfront sale. So there's a lot of issues on an earnout to think about as a seller.
Well, and the other thing is too, you can speak on this, whether it's venture guys or other guys that are in, they're not sticking around after the company gets sold. So the earnout, the onus of the earnout, when you look at distributing the value of the deal, these guys are getting their money first, right? And so who's left with the bigger chunk of the valuation that gets attributed to the earnout? It's you guys, right? So you're not getting the money up front, so you got a bigger risk profile than your other investors do as well.
Okay. All right. Well, thank you. I mean, I think we're out of time, but thank you for to the panelists.
Welcome.